Hi to everyone. Thanks for coming today to this investor conference for us presenting Q3 and 9-month results. Please interrupt me throughout my presentation to answer any questions you may have. Or when I finish, if you have more detailed type questions, please be my guest, join me for a discussion. So our Q3 and 9-month presentation, new ideas, we continue to grow. We keep having a habit of breaking records like Q3. It was the highest ever in Aspis' history in terms of profitability quarter. We go see more detail. On key corporate events, we made a note on the interim statement that the company will pay a dividend, a preliminary dividend for 23 in December, but we already paid a final dividend early July of $0.25 a share. We continue this, and we will see it in a different slide. We continue paying a significant dividend out of our profits for 7 consecutive years starting 2016, and we have a tendency to continue to pay a significant dividend payout to our shareholders. On the retail side, we managed to agree with TK Maxx stores, another significant retail player, because this is becoming more and more significant for our business. We aim to grow further the retail business. We have a lot of product lines available to this business. Logitech is a big one. B&O, Bang & Olufsen is a significant also. TCL, Lowe, and a lot of other brands to address the retail channel. And we continue with new products and solutions in the markets where we trade, as a means to further grow the top line, but also more importantly, maybe the bottom line of the company. So revenue growth continues. Historic numbers. Even September last year was highest ever. We managed to overachieve that by even 4% this year. And we continue the growth. You can see the chart. So there is growth potential with the existing suppliers, especially considering expansion to new markets. Talking about new markets, given the growth in Central Asia, mostly with Apple, but not only, we established a hub, a distribution center in Georgia, coming closer to the customers. Throughput time is much less, therefore we give better service to clients. But at the same time, very recently we established in Johannesburg, South Africa, a regional hub to being able to address business in the sub-Saharan region. And we expect extra franchises from suppliers to enable increased business in the country and nearby countries. On the financial results, Q3, year-on-year comparison, 11% growth on the top line, gross profit up by 10% to almost 62 million. The gross profit margin still very high, 7.99. And most importantly, the net profit has grown on a year-on-year basis by 11%, reaching 22.2 million. When it comes to key countries, revenues by key countries, Kazakhstan is by far number one, still retaining his number one position. Ukraine, though we've lost business from peak sales of 21 prior the war. We are still growing the business with a lot of suppliers. Main one is Apple. United Arab Emirates, still number 3, strong business. Slovakia has done a tremendous job this year and has significantly grown the business on a year-on-year basis. And we have Central Asian countries also in the top 10 league. Poland is advancing in the top 10 range to number 7, created the necessary infrastructure, and we believe there is a way to further grow the Polish business. Revenue by product lines, smartphones by far number 1 business of ours, a 6% growth year on year. CPUs, I think we discussed it previous times I was here. We expected a significant growth from CPUs because certain suppliers, specifically Intel, had decreased its business, and we expected a revamp of the Intel business, something we already see in Q3. We see a 50% growth on the CPU segment. The laptops business has lost 14% year on year. I don't believe this is a permanent. We don't believe this is a permanent trend. It's owed to a lot of factors. We expect that to also start picking up. More importantly and more profitably, servers and server block business, more and more is coming to us, a significant almost 70% growth year on year. I repeat, with very high margin, higher than average margin. Revenues by regions, FSU by far number 1. Russia is out, as we all know, but significant growth. We saw it before by countries. Kazakhstan is leading on the FSU side sales. Ukraine is number 2. And we have this Stan franchise countries by Apple growing very quickly for us. Uzbekistan, Caucasus, Armenia, Georgia, Azerbaijan growing very quickly for us. Central and Eastern Europe has made a significant increase in sales in Q3. The leader is Slovakia, has done tremendous business, also project business, very profitably. The Middle East and Africa, relatively flat, only a 2% up, but very strong business. And more we expand with franchised products into Western Europe. Therefore, a very significant Western Europe year-on-year 50% increase. Overall, Q3 year-on-year 11% up. Given the instability in the markets we trade, we believe this is a very satisfactory top line increase. The gross profit margin, we expected some stabilization of this margin. We saw very significant, very high levels for the ASBIS history margins previous quarters. Now it seems that is a little bit lower, but still very high. 7.99 is a very high, we believe, gross profit margin. And we believe there is further possibility to develop it on one side, but on sustainability side, we believe that this margin is a sustainable margin. 7.5 to 8% is a sustainable margin for the company. We've seen higher margins closer and right after the war in Ukraine, but then we saw some rationalization, some flattening, some normalization of the gross profit margin. SG&A costs, we made significant investments, as we discussed a lot of times, in human capital to develop new business. Therefore, SG&As have significantly increased also as a function of mostly gross profit rather than sales. We expect the necessary payout coming from sales and gross profit to excuse this significant increase. But, these last few quarters was an investment time, the outcome of which was not expected from day one. So this is what we see in front of us. We see an increase, but on the other side, sooner than later, sometime next year, we expect to see results coming out of this. I repeat, Q3 was the highest profitability quarter in ASBIS's history. We achieved 22.2 million profit. Yes, with some one-offs, but we are very satisfied given the overall market situation. We are very satisfied with the results we have achieved. A net profit that year on year shows a 10% increase. Full income statement for Q3 year on year and the 9 months. We touched the top line already for Q3, 11%, reaching 772 million. For the 9 months, a 14% increase, reaching almost $2.2 billion revenue. EBIT showed some slowdown by 5% for Q3, a plus 7% for the 9 months. I wanted to also note that the net financing cost is significantly increasing due to the base rates increasing in all the countries, both the euro, the dollar, but also the local currencies we borrow at became quite expensive. And we see significant increases. Q3 shows a 38% historic high net financing cost figures, and very high, again, historically, the highest base rates we pay in different currencies. Just a small estimate, we expect this to smooth down, stay flat, maybe another 0.25 basis points up, and then we flatten out. And analysts expect by end of Q2 to be the same. But then depending on the inflation rates, we expect this to start coming down and start seeing other things being equal, turnover and others being at the same levels. We expect to see a slowdown in the net financing cost for next year. Historic high, that's the summary on financing cost that is negatively affecting our both Q3 and 9-month results. At the end of the day, as I said, with the one-offs, we managed to deliver a 22.2 with a net margin of almost 2.9%, which keeps the company, keeps its directors quite satisfied with these results. On the net working capital side, we have managed to produce a positive number from operating activities in Q3, though a small one, a little bit more than 3 million, but we are gradually closing the gap from the negative cash from operating activities, expecting to hit a positive number, generate a positive number for the full year, 2023. On the CapEx, on the investing activities, the CapEx has lowered as a number because we sold some fixed assets we didn't use. Therefore, this is improving the outflow on investing activities. I think that characterizes our 9-month cash flow. Again, with the expectation that we should be able to deliver both a positive a generation of a positive number from operating activities with a much improved cash position at the year end given the seasonality. The debt of the company is at, we believe, at reasonable levels as compared as a ratio to equity. If I were to include also factoring advances to this debt, we are sitting end of September with $121 million total debt. That represents a ratio of 0.4 to equity of the company. Very reasonable, we believe. I wish I could say the same on the cost of it, but as you might have seen on the interim report, the weighted average cost of debt continued to go up. For the 9 months, we calculate the weighted average cost of debt of 12.0%. And if you recall, for the whole 2022, we had a weighted average cost of debt of 10.5%. The outlook of the remainder of the year, we are talking about the best quarter in the year, also the case last year. We expect the same to happen this year. November is a determinant of a very strong Q4. We started well, both October and early November. We believe we should be able to achieve a strong Q4 number, therefore being able to achieve the forecast we have given to the market. The new product introduction, mainly Apple, is expected to show numbers in Q4. Another reason why Q4 this year is expected, as usual, expected to show good numbers, both top line, but most importantly, profitability numbers. Tracking the forecast we have given to the market, starting with the revenue, we said to the market that we should be able to achieve sales between 3 billion and 3.2 billion. Now we are sitting at 2.2 almost. Therefore, we have achieved so far about 69% of the top line forecast. On the bottom line, on net income, we have told the market that we expect a net profitability of $78 to $82 million. So far, we achieved 51, rounding the numbers. That represents about 62% of the announced forecast to the market. We strongly believe, and we are confident that we should be able to achieve this forecast, both on the top line, but most importantly on the bottom line for 2023. The 2024 outlook looks very strong. We have more Apple products. The iPhone 15 is selling quite well. As I said earlier, I expect the impact of that to show in Q4. The big numbers are in Q4. We pay more emphasis on the own brand with higher the margin. On the market side, we continue to focus with Apple and not only on the CIS market, especially the franchise with Apple markets of Central Asia. We still develop Central and Eastern Europe and now more into Southern Europe. As we saw earlier, Slovakia has been very strong and we continue to push business through Slovakia. And we have new opportunities to African markets with a lot of suppliers, some of which are expected to be announced in the near term, assuming we agree and we sign. Some of which are already there, but big franchised products, vendors, will give us a booster in terms of growth for next year. Sub-Sahara, mainly countries, but also there is a chance to further develop Africa, North Africa markets. That's why we established the hub in Johannesburg, to being able to be closer to the customer, shrink the throughput time of products to customer, and provide better service to our customers as a mean for further growth for next year. Our focus is still more and more into corporate clients, but we also address the retail channel, very important for us. Higher the margin, yes, higher the inventories and the receivable days we have to grant to customers, but it pays off in terms of improved than average profitability. Some risks and opportunities. We see instability in the markets where we trade, given the war in Ukraine, but also a very recent in Israel. Inflation is at historic high levels, therefore the interest rates keep going up. As I said earlier, hopefully we are close to reaching the peaks, therefore we see lower in the next year. We also see growing HR costs, but on the opportunity side, we see some rebound in the customer demand, though inflation is affecting disposable income of people. The private labels seem to have a very niche but profitable business with higher margins than third-party products. And as I said earlier, we are seeing an opportunity to grow in new markets as a means to grow revenues, as a means to grow profits. We discussed about dividends. We discussed about the actual payment early July of the final dividend relating to 22 results. But we also noted in the interim report a preliminary dividend to be paid early December for the 2023 results of 20 cents a share, lifting the total payment for the year to $45. Historically, as you have seen as you see on the chart, consecutively, year after year, we kept paying a growing dividend payout, starting with 2016. So for the last 7 years, we have been out there paying a significant part of our profits to shareholders as a dividend, and we aim to continue to do that. I think that summarizes Q3 and the 9-month results and business. And we welcome any questions you may have on these, either now or right after you have absorbed better Q3 and the 9-month results. We are always there to address any questions you may have.
Do you expect any other one-off items which could affect your results in the fourth quarter?
The disposal of the second and last subsidiary in Moscow, we faced a lot of sensitivity over Russia. So the second and last business we had in Russia was disposed of in October. That will depend on the balance sheet end of October. That's the agreement. So this, depending on the balance sheet to exist, is expected to give some one-offs, and we close the chapter Russia and we close the sensitivity. But that's in Q4. That we already mentioned in the interim report, Jakub. It's already there. Even on the group structure showing the entities, we put a note to say that was disposed. And post-balance sheet events, we also noted the disposal of the second and last subsidiary in Russia. So this is expected to be one-off. Now, the buildings we don't use. For example, we left Limassol, the old corporate offices, and we moved to a new high-tech 11,000 square meters, etc. The previous one was sold. We do the same in Middle East. As the business grows, we go to a new place. There is a chance we further sell. If we sell it in Q4, I don't expect any significant one-off there, of course. We don't want to stay on assets as investment properties. Yes, we use it for the business. If we don't use it for the business, the clear intention is to sell it. Yes. Other than this, other than the historic high financial costs, I don't know if this is a one-off. Seeing the trend of keep increasing, now somewhat flattening, but obviously it badly affects Q3 and 9 months and full year 23, yes, historic high, yes. We have here 40% increase in financing cost. We used to have, you recall, 22 to 23 million net financing cost. We are hitting 34 to 35 million this year. You know, this extra, 15 million, 13, 14 million is profitability amounts. If we start next year seeing the slowdown, which we expect starting end of Q2, then we are talking about significant savings, yes. Will it happen depending on the inflation rates coming down? We expect. If business will not stay the same, but if business is the same, then we expect significant savings next year, yes. These are, to me, one-offs, yes. Both positive and negative.
What is the reason for so big inventory? Do you have also this year any special contracts with Apple?
There are various reasons why the inventory is high. One of the reasons, I think I said it indirectly earlier, is addressing the retail customer requires more inventory. I also said it when I mentioned the regional hubs, distribution centers. When you open one in Georgia and one in South Africa and you start loading with product to serve the customer better, you expect higher inventories, yes? These are two main reasons, but also growth of the top line requires higher the inventory. We are hitting 3+ billion sales this year, yeah, representing a double-digit increase year on year. That requires extra inventories, yes. Now, is the 480 million we show a representative number? Do we expect the same number for end of December? No. We expect lower number, but it will not go to, if I look 2 years back, 330, 350 range, it will be higher. I don't expect anything more than 450, 460 year end. Maybe that's already too much, depending on how good you perform sales in Q4, yes. But yes, the inventory is at higher levels than it used to be, yes.
And what do you think about cash flow in the end of the year?
I believe we should be able to generate a positive cash from operating activities with much improved cash position at year end. We already closed the gap significantly in Q2 when it comes to cash from operating activities. Another small closing of the gap in Q3. We are sitting today at -37 negative cash from operating, and given the seasonality and the trends characterizing Q4, I expect to being able to generate a positive number, not just for Q4, but for the whole year, turning the whole year positive on operations, with a cash position much higher than what we see end of September. That's what we expect to see on the cash flow. With lower the cash from going out of the company from investing activity because of the disposal of certain fixed assets we don't use.
You haven't mentioned anything about possible change in forecast this year.
Because we don't have any clue that gives us the right to come out to the market and say we go revise the forecast. We don't have any we achieved a significant part of the net profitability. If Q4 behaves like Q4, we should be able to achieve the forecast. I said exactly the opposite. I think we are confident to being able to achieve Q4 and the whole 2023 forecast. Yes.
You believe in achieving forecast on adjusted basis or on a reported basis? Because the first quarter was increased by significant one-off items. So
Yes. When we announced the forecast, we didn't make the distinction. So if you start making the distinction on a quarterly basis now, I don't know if you will confuse more than clarify more to investors. The 78 to 82 is the bottom line forecast. I repeat, we should be able to achieve it. Now, I don't know the figures on any other one-offs for Q4. I don't have a figure in front of me. One by one, we have to see how the disposal leaves us on the balance sheet of end of October, and then we see. Any more questions?
Can you tell us more about your sales in Western Europe? These
Yes.
are big markets.
Yes.
And you said last time that the big tech companies, they don't want to cooperate with smaller distribution. So what can we expect for 2024 in the Western Europe countries? How you see it?
We are building teams in Western Europe because we are franchised with a lot of suppliers to sell throughout Europe. Though we are not fully infrastructured with subsidiaries in Netherlands, in the UK, in Germany, etc. We have sales in these countries. And putting more infrastructure, more salespeople on the ground helps us grow quickly. But with products we have already, we are authorized to sell products there. It's nothing, no new franchise to us. It's existing franchise we make a use of now. Yeah?
But considering how big these markets are, can you expect that you will grow there perhaps more quicker than,
Yes.
than in the other regions?
We don't want to go place another 20 entities in Western Europe with another, 300, 400 people there. We tried the sales way, the sales manager's way there is improving sales and is leaving good profit. It's not just sales, it's profitability. We saw that this way works better for us. Now, if this business proves to be a very significant business, a very significant opportunity for more business, we will not hesitate. But day one, we don't want to build another few subsidiaries there and a lot of stuff there. We don't want to do that. And we have similar examples happening elsewhere, like in Dubai, for example. We are selling to Saudi Arabia. We used to have a subsidiary there. It didn't pay off. We couldn't cover the cost, though we have good sales and good customers. But we are selling through the Dubai establishment, yes. Not necessarily we need to build teams there and companies and expenses.
regarding cash flow, you mentioned that
Yes.
it should be positive for a whole year.
This is what we expect, yes.
And what about working capital change throughout the whole year? Should it be positive, negative?
We expect it.
It already increased very much in 2022, and there was some expectation that it should normalize during 2023, and we still don't see it after 3 quarters. So do you believe it is possible that it will decrease throughout the whole year, or?
It will decrease. It will decrease in Q4, given seasonality, given higher sales. Given higher sales means you're clearing more of the inventory. So if the inventory comes down to lower than 450, obviously it will have a positive impact on the working capital, yes. But addressing the retail customer earlier, I said, is creating more burden on DSO and on the working capital, obviously, yeah. It took us longer to dispose of the stocks we bought end of last year, and that had a negative impact on the working capital for the 6 months and for the 9 months. So I think Q4 will be a determinant of improved working capital, and we expect to see better numbers. Now, internally comparing Q3 working capital days and cash-to-cash cycles is much improving from Q2. Yes. Okay, inventories didn't come down significantly, but 18, 19 million here. Receivables are getting better. You know, it's improving. It's improving, and it's also seasonal. Yes. You cannot extract the picture for the year by just looking at H1 or the 9 months. The best working capital picture is Q4, historically. Yeah. But there are improvements, Gregor. There are improvements.
Last question regarding investments, because as I saw throughout 2 years, the employment increased 30%. And so the SG&A costs, when do you believe that these investments should start to paying out?
We told the market that we expect the second half of this year to start giving significant numbers. We have some difficulties in delivering strong sales and gross profit numbers. Therefore, the investments stayed the same. We didn't release stuff, and we expect we should be able to, given the backlog we see, should be able to deliver good benefit out of these investments in 2024. The first triggering point, of course, will be Q4. We have to see what they can finally deliver in the best quarter of the year. Yes, we expected the investment to come first and the outcome to come not the next day, but after a couple of quarters. So we expect to see that starting this year, starting Q4. And then the next turning point is the budgets. You know, we have to decide on the budgets depending on what they have managed to deliver up to and including Q4. What do we do for next year? Do we stay with the same investment? Are we seeing the numbers coming? And we are strongly believing into getting this benefit finally in 2024? Or not? We expect the same. We expect to see the benefit because we made significant investments on new businesses.
And how much of this additional inventories from Apple from the fourth quarter is still on your balance sheet?
Very small. I don't recall the figure, but most of it was sold out by end of Q3, like the target was, with very small remaining at APR stores. So that was significantly disposed. We sold that.
So it should be cleared in the fourth quarter?
Yes, yes. Cleared completely because the bulk of it was cleared out by end of Q3, yes. That's also a burden to Gregor's question earlier on the working capital. That negatively affected the working capital utilization for the 9 months. Yes. So clearing of that will bring improvements to the working capital. All right. Thank you for your questions. Thank you for your attendance today. And looking forward to having a light lunch with you guys. Any questions on the side are most welcome as always. Thank you.